Good afternoon, everyone. Thank you for joining today's Capital Management Corporation webinar and for November 2023. We appreciate you joining us. A few things before we get started. I wanted to remind everyone that the webinar will last about 30 minutes, and then we will answer questions. Speaking of questions, you should have a panel on your screen. And on that panel, you'll see a heading that says questions. You can click on the caret to the left of that. A menu will drop down. You can type in your question. You can send it to us privately, or you can send it to the entire group if you'd like to. We're also recording this, and we will post it up on the website. On Monday, you will get an email alerting you of the webinar being posted, and we encourage you to share it with anyone that you know that might be interested in our thoughts about the market at this time. So before I get into the agenda, I am going to pass it to Tim real quick, who's going to share a few words.
Thank you, Scott. The October 7th invasion of Israel was horrific. Our hearts and prayers are for all of the victims. This webinar is focused on our economy, the financial markets, and our outlook. We will also highlight how our in-depth company research is producing results. Scott?
Thanks, Tim. Also joining us on the call is Mark Livesay. Mark is Vice President and Portfolio Manager, and we're going to go ahead and jump into the agenda right now. So, as typical with our previous webinars that we've had, and if you've joined us in the past, we typically cover three overarching topics. First being economic backdrop. Mark is going to discuss a host of different things that are going on in the economy, but he's going to delve much deeper into the interest rate and bond yield environment, more so than we have in the past. I will discuss the market landscape and the volatility issues that we've seen, particularly as of late, and Tim will give his thoughts on the current and long-term investment strategies considering today's environment and long-term. So with that said, I am going to pass the torch to Mark.
Thank you, Scott. Appreciate it. And as Scott mentioned, I get to cover some of the more macro trends. And the first one we wanted to highlight here is, generally speaking, the economy has been much stronger than most would have predicted so far this year, particularly in the third quarter. As a reminder, 2/3 of the economy is based on consumers, and strength in employment, wages, and savings have led to a stronger than anticipated consumer. Credit card balances are rising, but are not yet unreasonably high. Credit card balances expressed as a percentage of household assets remain below pre-pandemic levels. So there is some strength available for the consumer. Strong housing prices have also helped consumers, particularly those that locked in a 30-year fixed rate mortgage in between 2009 and 2022 at very attractive rates. So many consumers are insulated from roughly 1/3 of the CPI, which is shelter, and we've spoken about that at length on prior calls. But so there is that insulation from inflation if you do have a 30-year fixed mortgage. All that baked in the cake together, third quarter GDP was 4.9%, which is a very strong number, and unpredictably strong number. We do believe the third quarter was helped by a buildup in inventories that likely will not be repeated in the fourth quarter. We do expect fourth quarter GDP to be lower than the third quarter for that reason, but still expect a positive number in the fourth quarter. And next, I'm going to spend some time in the exciting world of U.S. Treasuries. So this chart is a representation of the yield curve. It's got three different dates in time, the yield curve on three different dates. The top blue one is at the end of October. The middle green one is at the beginning of the year, end of last year. And the bottom gray one is 2 years ago, the end of 2021. So we know that the Fed controls essentially the y-axis, so rates at the very, very short end, the overnight rate, and rates were 0 at the end of 2021, and we're in the 4.5% range at the end of 2022, and sit today at between 5.25% and 5.5%. We did learn yesterday that the Fed did not increase the interest rate in their November meeting. We do not believe that they are likely to increase it in the December meeting. And one of the reasons for that is that longer term rates, so if you go from the left part of the page to the right, you go out in duration of your bonds, those rates have also increased meaningfully. So the 10-year Treasury was below 2% at the end of 2021. It did hit 5% on October 23rd. It has since retreated a little bit, but we wanted to delve into kind of some of the issues that might make longer term rates continue to rise. So on October 23rd, rates basically across the entire yield curve hit 15-year highs versus the end of both 21 and 22. Longer dated maturities were much higher, as I mentioned. This does have an impact of tightening financial conditions. So it's essentially doing some of the Fed's dirty work for it. They don't have to increase the short end of the curve or the short end of the overnight rate nearly as much as they would have if the 10-year and 5-year rates had not increased as much. So if you had just said that GDP in the third quarter was going to be close to 5%, inflation was still stubborn in the 3 to 4% range, the labor market was very strong, we would have probably guessed, given those factors, that the Fed would have increased in November and would likely have to increase in December. But we do think they're paying attention to overall markets and the volatility in the longer end of the curve, and they're not having to act as much as they otherwise would have. So the next two charts kind of provide an explanation for the rise in longer duration rates. Number one is that the economy was stronger than thought. So one of the reasons longer term rates would remain low is if you thought a recession was imminent. And many did at the beginning of the year think a recession was imminent, and that has not been proven to be true. But on this chart, we show the Federal Reserve holdings of US Treasuries in the orange line and the corresponding 10-year Treasury interest rate in the blue line. So the Fed continued the massive pandemic-related QE program until May of 2022. Since then, the Fed has reduced the amount of treasuries on the balance sheet by roughly $850 billion, with runoffs at $60 billion per month. Treasuries held at the Federal Reserve are represented on the orange line, so you can see that orange line going down shows a reduction in the treasuries. This is known as quantitative tightening, and it has essentially removed a large buyer of treasuries from the market. So the largest buyer of treasuries since the financial crisis until this most recent runoff was the Federal Reserve. So when you remove a large buyer, you might expect that rates would go up, and that's what has happened. Other typical buyers of treasuries may also have incentives to reduce holdings. So U.S. bank treasury holdings are roughly $154 billion lower than a year ago. As we've spoken about before, banks received massive deposit inflows from the excess savings of the pandemic. Those banks then went and purchased bonds with the deposits to make money, and they now have large losses on the value of their bond portfolios because interest rates have risen. After the failure of Silicon Valley Bank, banks are much more acutely aware of interest rate duration risk and may not be increasing their treasury holdings and want to reduce their interest rate exposure of their bond portfolio. Foreign central banks are also large buyers of U.S. treasuries, and many of those might be wanting to sell treasuries as a way of defending their currency versus a strong dollar. So that's the demands picture. We have some of the natural buyers of treasuries having reasons to step back. Other bond investors may have already extended durations when the 10-year Treasury first crossed 3%, or perhaps when it first crossed 4%. And since we know those are longer duration assets, they no longer have dry powder to deploy. And we do expect the Fed, and they've said they're going to continue to let their treasuries roll off. It's also not clear why foreign central banks or domestic banks would suddenly be in a change or suddenly be in a rush to change their policies. So all this is to say that the demand for treasuries has been down, and future treasury buyers might need a larger financial incentive than past buyers to buy these bonds. So this should keep upward pressure on interest rates. Another side of the equation would be the supply of treasuries that the Treasury needs to sell to fund government expenditures. The third quarter saw over $1 trillion, that's trillion with a T, in treasuries sold. This is the second highest quarter, only behind the pandemic-related response in the second quarter of 2020. On Monday of this week, the Treasury Department has estimated that they will issue $776 billion of treasuries in the current quarter, and will have to issue $816 billion of treasuries in the first quarter of next year. Those are the lighter blue lines on the chart. The current quarter estimate was actually good news because it was $76 billion below the estimate they gave in the summertime. This change was cheered by bond investors, and since Monday, we have seen the 10-year Treasury fall roughly 15 basis points, which is a large move in treasuries. And we are currently sitting roughly 30 basis points, so around 5.69% below the October 23rd midday high. So we don't trade treasuries daily. We buy them to hold till maturity. But we have observed recently that volatility in the treasury market has tended to be the determining factor for volatility in the stock market as well. Days when bond prices fall or rates have risen, stock prices have tended to fall as well. And the opposite has also been true on days when bond prices rise, i.e. rates fall, stock prices have tended to rise as well. So there's been a lot of volatility in the financial markets as a whole, in both bonds and stocks. And the sentiment in the short term can really determine those short-term moves. And I'm now going to turn it back to Scott to talk more about some of the other sentiment factors that we've seen influencing the markets.
Along with interest rates, there's been other forces that have caused volatility within the market, particularly the last 2 to 3 months. The Middle East, the horrific situation in the Middle East, as well as still going on in Ukraine, has had an effect on the market sentiment. We have record debt, actually just reached $33 trillion. We've had a threat of a government shutdown a couple months ago, and may be facing that again in a couple weeks. And all of this has led to consumer confidence, which has dropped the last 3 months, according to the University of Michigan Confidence Index. All of this has created quite a bit of volatility within the market. As major as these events are, at the time, financial markets over the long term do remain resilient and bounce back from a long-term perspective. On this slide, this shows the MSCI Global Index, which contains 1,500 large and mid-cap companies across 29 developed countries. Think of it as the S&P 500 for the world. Despite very challenging events dating back to 1987, as you can see on this slide, you can also see that the index trajectory since 1987. In fact, if you measure back to 1985, which is 38 years, the MSCI World Index has a growth rate annually compounded of nearly 8.5%. So the takeaway is that the market is going to be shocked and stressed with events that are occurring today as they have in the past. But the perspective is that over the long term, markets do bounce back and they do remain resilient. With that, I'm going to pass it over to Tim, who is going to talk about investment strategies moving forward. Tim?
You have savings and wealth, capital, and investments. What are the objectives and parameters for each account? We ask clients, what is your goal? Is it wealth preservation, long-term growth, or rising cash income? The most frequent response is just one word: yes. So how can all of these goals be achieved? Now that rates are near 5%, does it make sense to invest everything into CDs, bonds, what Wall Street calls fixed income? Of course, some banks did this at 2%. We were asked this question at 3%, then at 4%. Our response today is similar. Let's look at this example. What if you were able to buy long-term U.S. Treasury bonds at 5%? Well, you are successful. So let's assume your incremental federal income tax rate is 37%. You also deserve to have your needs met. So let's have a 4% distribution rate to offset some living expenses or accounting, trust, attorney fees, forced trust distributions. And what if inflation fell to 3%? All right, here's the math. The 37% tax lowers the bond return to 3.15%. The bond portfolio's value is then hit with the 4% annual distribution. Now the portfolio value is negative 0.85. It's lower than where we started the year. Did I mention inflation? Just a benign 3%. Within 1 year, the portfolio's value in today's dollars is 3.85% lower than where we started. Compound that negative return, and after 14 years, 1/3 of this portfolio's value is lost. Remember those investment goals? Whether 100% CDs or bonds, did the portfolio preserve wealth? Is there long-term growth? Was there generation of a rising stream of cash income? Do you plan to spend year 15 eating cat food from a can? Now, let's look at stocks. Wall Street likes to call these equities. The 50 and 100-year annualized results, U.S. large cap stocks have produced 10% annualized returns over those time periods. Theoretically, that's a double every 7 years. Some other categories did even better. Small caps tended to outperform mid caps, which outperformed large caps over the last 50 and 100 years. Dividend growers outperformed all dividend payers as a group, and they in turn outperformed the major indices. Stocks with lower valuations perform better than expensive stocks. Compounding at more than 10% over 50 and 100 years is fantastic. However, there's market volatility, varying entry prices, and normal human emotions. As Scott showed, there are always reasons to worry. We consider large cap growth stocks, many tech stocks, to be too expensive today. Similar to the 1972 peak of the Nifty 50 or the Y2K peak of the dot-com bubble. The subsequent 3, 5, 10-year performance for large cap growth indices was subpar. That would be kind to say after the 1972 and year 2000 peaks for large cap growth. For the 10 years after 1972, the Dow Jones had a hard time breaking 1,000. Basically, had a 10-year return of 0. After Y2K, the 10-year return for the S&P 500 was worse than 0. Entry valuations are key. When we look at that Y2K peak, yeah, everybody had to own large cap growth. Everybody had to own the largest leaders that would continue to be leaders. The 6 largest companies included Coca-Cola, Intel, Cisco Systems, and General Electric. Well, putting all the pieces of General Electric together and those other 3 stocks, they're at lower prices today than they were 23 years ago. That is not a good 23-year return. Entry valuations are key. And large cap stocks were expensive then. So some ask about Black Monday. They say, gee, we're worried that will happen again. But also, you want to take advantage of that situation. After Black Monday, I remember many older, wise people said, well, gee, we missed that one, but the next time it goes down like that, we're going to be buyers. Well, we've had many cycles since then, and those individuals are nowhere to be found at market bottoms because they're scared. They have normal human emotions. Well, in 1987, the market peaked at an all-time high in late August. But then from August 25th to October 20th, the market fell 36% from the intraday high in August to the intraday low in October. Well, it's very hard to get that exact pricing and to trade in that 1 nanosecond to get the absolute high and low. Let's say you traded at the end of the week. So if you traded on Friday, August 28th, and then on Friday, October 23rd, well, that decline in the market from the end of the week of the all-time peak to the end of the week of Black Monday produced a 24% decline in the S&P 500. It was drastic. It was seared on our minds. Well, today, the 2 major small cap indices are 27% and 32% below their November 2021 highs. They've been in a 2-year bear market. Down 27 and 32%, that's a lot better than the 24% that you could take advantage of in 1987. So where are we today? When we look at equity valuations, again, we see the large cap stocks are quite, I would say, overvalued. As entry price matters, do you want to pay 30 times earnings for your portfolio? Those 7 stocks represent over a quarter of the S&P 500. That's an expensive index. It has a few attractive components, but on average, the index is up to 17 times earnings because of it's being dominated by those very expensive large cap tech stocks that are very stingy with their dividends. Usually mid caps are more expensive than large caps because they can offer better long-term returns. Usually small caps are the most expensive category on this page. Well, the world is upside down. And small caps and mid caps are compelling buys. They've been ignored. Everybody had to be in a large cap growth rally. It is quite rare to see small caps and mid caps be cheaper than large caps, but to be this much more attractive is not seen that often at all. But you don't have to buy all 400 mid caps or 600 small caps. Why not concentrate on a select group of profitably growing cash generators? Make a dividend while you wait. On this next page, you see our model portfolios, and we've taken advantage of these great opportunities. Growth in income and dividend appreciation, all cap growth portfolios are just that, they're all cap. They have large caps, mid caps, small caps. Yeah, our entry valuations are compelling, and we see future profits, profit growth, excess cash generation from these companies, and what attractive dividend yields. They are not stingy at all. These are shareholder-friendly companies, most of them paying dividends, and those are the average dividend yields of the portfolios. And small caps, they tend to be the most expensive area. This is an absurd opportunity. We do not see this that often at all, and you almost get a 3% dividend yield to boot. By the way, those dividends are qualified. They receive a lower tax rate than the U.S. Treasury bonds and corporate bonds and bank CDs. We not only expect compounding from growing earnings, but we expect to see valuation multiple expansion. On top of that, you get dividends. And if history repeats itself, we expect a lot of dividend increases. People say, oh, there's too much volatility, too much risk. We don't know all of the companies. And we recognize companies like Microsoft. Well, 40 years ago, Microsoft was a small cap. What generated that 40-year investment return of Microsoft? Was it a 1980s small cap that generated that 40-year return? Or is that the 40-year return of a 2023 mega cap? When companies get enormous, their future growth is not as great as their past growth. Well, let's look at some of our holdings. Many of our undervalued cash cows are small caps and mid caps. These four stocks also pay dividends, and each had a dividend increase or two over recent years. We highlighted InterDigital on a webinar less than a year ago as the 5G patent holder collecting royalties. It was an undervalued cash cow. It's up about 61% this year since roughly when we had the webinar. It reported earnings this morning, up over 100%. You can be selective. You can get some really attractive companies that are being ignored because everybody's focused on those large cap growth names as they watch the TV. Even people on Wall Street watch TV. But we are seeing some changes in market leadership. Some expensive tech stocks are reporting decelerating growth. Order rates have peaked. Valuation multiples have plenty of room to fall. Well, one benefit of undervalued cash cows is that they are already undervalued. They're at attractive entry prices. Well, what has changed in the last 6 months? In the last 6 months, we have seen Greenhill double on a Monday with a cash takeover offer. Franchise Group moved up a third ahead of its takeover announcement. One day last month, Textainer surged almost 50% on its takeover announcement. Well, yesterday, after this chart was made, some of our other cash cows had news. Acme announced the divestiture of 2 smaller units, Camillus and Cuda. The proceeds will more than pay off all of Acme's variable rate debt. Interest expense will plummet, and investor attention can then better focus on Acme's faster growing units. By year end, we expect Livent, our lithium company, to merge into a slightly larger Australian firm. And our 3 regional broadcast media firms will benefit from several trends over the next 12 months. There is potential for high double-digit, even triple-digit returns from individual stocks. This is what we do. We find amazing opportunities, and the longer Wall Street ignores them, the greater the opportunity set becomes. And so, with all these changes, people say, well, is this the time to invest cash? And there's a seasonality of the market. And surprisingly, the 30-day rule might have something to do with that, in that the vast mutual fund complex has to report their gains and their income and provide their distributions to investors before year end. The only way they can do that is by making their fiscal year end in October. Well, they want to claim that they're tax efficient. So some of them sell all of their potential tax loss positions. Any stock that's gone down, it could have gone down for a good reason, for a bad reason. It could be down for no reason at all. Well, they'll sell it to try to improve tax efficiency. So in September and October, these people up in New York and Boston and San Francisco, they keep hitting the sell button over and over and over. The stock's already oversold and they keep hitting the sell button. Well, what do normal buyers do? They're taking their last summer vacation. They're getting their kids prepared for school. They're going crazy. So then they call the grandparents and say, we're dropping the kids off there. And then the grandparents are preparing for that visit. What are we going to do with these kids as they arrive during the witching hour? I don't see any buy buttons being hit. So it's just the mutual fund complex hitting the sell buttons over and over. Some low valuations become even lower. Well, you can sift through it and find some great opportunities. And we've done that. And so this is an attractive time to put money to work. You have the seasonality of the market from late October to May. That's the best 6 or 7 month period for the stock market historically. On average, that's when all of the excess return over inflation or T-bills is earned by the stock market. Any year can be different. But on average, that's a good season, and we're starting that season. Part of the reason for that season is the tax loss selling in the low entry valuations of some stocks, their rebounds can be historic and have generated names. As those stocks rebound in November, December, January, and into the new year, some of the rallies are renowned as the Santa Claus rally and the January effect. Well, it's hard to buy now because this is when confidence is low. People have been beat up. There's uncertainty. There's always uncertainty. It's the media's job to scare you. Lower investment confidence is typically when you find the best entry points in the stock market. Well, what can your portfolio manager do with cash put in the account today? Well, they can use the 30-day rule to double up on some of these oversold positions, and then before year end, realize tax losses in some of the old tax lots. And so it can actually help your taxes. Well, they're great opportunities, and our in-depth research allows us to know some companies better than any Wall Street analyst. And we're told so by several companies. We are looking for undervalued, growing cash generators, cash cows. Over long time periods, stocks tend to move with their earnings. We can do better, not just growing with compounding earnings. By buying at low valuations, that enables additional money to be made as valuation multiples rise to deserved levels, or even just up to historic norms. In the meantime, many of our investments are paying dividends and raising them. We employ the same cash cow investment approach across all of our strategies. Our concentrated portfolios focus on the best opportunities. Why be forced to own anything else? Our select opportunities at today's prices excite us. They have higher potential than we typically see. In the short term, we will always have volatility, but we expect significant long-term compounding, which should not only protect wealth versus inflation, but it should also grow wealth long-term and grow it significantly. We want to thank you for joining us today. And back to Scott.
Okay, thank you, Tim, and thank you, Mark. We have several questions already sent to us. Mark, I think this one's for you. The first question is, what do you think the Fed's next move is going to be?
My educated guess is that the next move is going to be the same as the last move, which was yesterday, which was nothing. I think there is a debate, and it's hard to say whether the next move, if they do anything, will be up or down. I think the incoming inflation, employment, and GDP data will likely determine that. I would be surprised if they moved at all in December. At this point, given what we know, I would be surprised if they reduce interest rates in the near future. The current expectation is that the Fed will reduce interest rates by 100 basis points or 1% in 2024. I think as a firm, we believe that that is high. We would not see a 100 basis point or 1% move down in interest rates. Of course, surprises always happen, and there's something that you don't see happening that could create a situation where that happens. But our base case is that they don't move over the next few meetings, and also that rates are generally speaking higher than the market anticipates right now.
Okay. Got another question come in. Let me see if I can pull it up here. Since small caps, small mid caps have been undervalued year to date, what will normalized things look like going forward?
Well, there's a lot of room for appreciation from today's valuation multiples, and it's hard to say what the entire category will do. At the end of the last large cap growth peak in the year 2000, over the next 4 years, large cap growth had a negative return, and small cap value was up. I believe it was up about 60%. And that could have included small cap value or even micro caps. But you can be selective. You can pick individual stocks, and names that I liked. Some of them were triples, quintuples, or 10-baggers in the 2000s. During that decade, the S&P 500 was down a cumulative 11%. But there are plenty of stocks that were up because they started at low valuations, not at extremely high valuations. And so we're sifting through finding great companies. And they can be large caps, just not the mega caps. They can be dividend payers. They can be labeled as value stocks because they're so cheap. But we're looking for the growers, the ones that will have long-term revenue growth, earnings growth, and generate lots and lots of cash, a rising cash stream. Less than half of the publicly traded companies out there generate excess cash. Well, they're going to be in trouble as debt rolls over at higher interest rates. And they're going to be at risk, and they can't do much about it. But the companies that generate lots of excess cash, they can pay off their debt as it comes due. They don't have to roll it forward at higher rates. They don't have to beg the bank. And with all that excess cash generated and all the growth of excess cash generation, they can reward shareholders directly with dividends, dividend increases, share buybacks. And they can reinvest in their own future growth, and they can take advantage of situations, buy competitors that are in trouble. So we are very optimistic about our portfolio, and we're ecstatic about the next 3 to 5 years for our portfolio. And the 10 years should be very good too. But I'm not excited for the S&P 500 index.
Okay. Thanks, Tim. That appears to be the 2 questions that we've received. With that, we want to thank everyone again for joining us today. As I mentioned at the beginning of this call, we have recorded the webinar. We will be posting it to the website on Monday. We will send out an email to everyone who's attended today's webinar to view it on the website. If you want to see it again and/or pass it along to a friend or a family member who might be interested in our thoughts today. Again, thank you for joining us, and we hope you have a great rest of the week. Thank you, everybody.
Thank you.